Welcome to our comprehensive recap of Financial Management 2025, covering sessions 5 and 6. Today, we'll delve into recapping sessions V and VI, Risk and Planning for Success, a crucial overview for our financial management course, dated June 28, 2025. This session aims to synthesize the core concepts of financial risk management and financial planning and analysis, providing a holistic understanding of financial stability and strategic growth. Please follow me. In Session 5, our focus was on financial risk management, specifically protecting the company from adverse financial events. Following that, Session 6 introduced us to financial planning and analysis, which centers on optimizing financial performance and driving future growth. The synergy between these two disciplines is paramount. Effective financial management inherently requires both mitigating downside risks while strategically planning for upside opportunities. This recap aims to connect these vital dots, offering a consolidated view of key takeaways for a more holistic understanding. Let's begin our recap with Session 5, Financial Risk Management, or FRM. Its definition is clear: it's the practice of identifying, assessing, and mitigating financial risks to protect an organization's capital and earnings. The core purpose of FRM is to ensure financial stability, protect value, and enable sustainable operations. A fundamental key idea to remember is that financial risks are inherent in business. They cannot be completely eliminated, but they can, and must, be managed effectively. Understanding the different types of financial risks is fundamental. We categorize them into 4 key areas. First, market risk refers to potential losses stemming from changes in market prices, such as interest rates, currency exchange rates, equity values, or commodity prices. Second, credit risk also involves losses due to a borrower or counterparty defaulting on their financial obligations. Thirdly, operational risk encompasses losses resulting from failures in internal processes, people, systems, or from external events. Finally, liquidity risk is the inability to meet short-term financial obligations without incurring significant losses. To effectively manage financial risk, we utilize both measurement tools and mitigation strategies. Key measurement tools include value at risk, or VAR, which estimates the maximum potential loss over a specified period at a certain confidence level. We also use stress testing, which simulates extreme, unfavorable scenarios to assess the organization's resilience. For mitigation strategies, we employ diversification to spread exposure, hedging using derivatives to offset potential losses, and robust internal controls through policies and procedures to reduce errors and fraud. Then, transitioning to Session 6, we explored financial planning and analysis, or FP&A. Its definition outlines it as a function that provides financial insights and strategic support to businesses for better decision-making. The role of FP&A is critical. It bridges strategy with execution by connecting high-level goals with operational implementation. It also guides for resource allocation in order to ensure capital is deployed efficiently to maximize returns. And it monitors financial performance by tracking results against targets to enable necessary course corrections. The key distinction from FRM is that while FRM focuses on mitigating downside risk, FP&A is dedicated to optimizing financial performance and driving growth into the future. Our first pillar of FP&A covers budgeting and forecasting. Budgeting involves setting financial targets and allocating resources for a specific future period. It acts as a plan for what a company aims to achieve. Common approaches include incremental, zero-based, and rolling budgets. In contrast, forecasting is about predicting future financial outcomes based on current trends and assumptions. It represents an expectation of what a company expects to happen. Techniques range from qualitative methods, like Delphi and market research, to quantitative methods, such as time series analysis and causal models. The second pillar of FP&A is financial modeling. This involves building a quantitative representation of a company's operations, performance, and financial position, often utilizing spreadsheets. Its purpose is broad, including forecasting, valuation, scenario analysis, and supporting strategic decision-making. The core components of a robust financial model include the income statement, showing revenue, expenses, and profitability over time, the balance sheet, detailing assets, liabilities, and equity at a specific point in time. Then, the cash flow statement, outlining sources and uses of cash across operating, investing, and financing activities, and various supporting schedules that provide detailed calculations feeding into these primary statements. Within financial modeling, two powerful tools are scenario analysis and sensitivity testing. Scenario analysis models distinct future states by changing multiple inputs simultaneously. This helps us understand the full range of potential outcomes and guides strategic planning under conditions of uncertainty. In contrast, sensitivity testing isolates the impact of a single variable on a specific output. It is crucial for identifying key drivers and highlighting critical assumptions that require a focused analysis. Our third pillar focuses on performance metrics and ratio analysis. The primary purpose here is to convert raw financial data into meaningful, comparable insights. The benefits are manifold. It provides standardization for comparison, offers early warning signals of potential issues, assists in efficiency assessment, and directly supports better decision-making. Fundamentally, financial ratios allow for quick and effective assessments of a company's financial health across various critical dimensions. We explored several key ratio categories, starting with liquidity ratios that is able to assess a company's ability to meet short-term debt, with examples like the current ratio and quick ratio. Profitability ratios evaluate profit generation from sales and assets, including net profit margin, return on assets (ROA), and return on equity (ROE). Lastly, solvency ratios gauge a company's ability to meet long-term debt, with examples such as the debt-to-equity ratio and times interest earned. Each category provides a unique lens through which to view a company's financial standing. Beyond simply calculating ratios, we learned how to use them for deeper insights. Trend analysis involves comparing ratios over time to identify patterns, whether improving or deteriorating financial health. Benchmarking entails cross-sectional analysis against competitors, or industry averages, providing crucial context on relative performance and areas for improvement. Finally, DuPont analysis is a powerful tool that breaks down return on equity into profitability, asset turnover, and financial leverage, offering a comprehensive view of its underlying drivers. Ultimately, analyzing ratios effectively reveals crucial insights into financial health and guides strategic interventions. In conclusion, financial risk management and financial planning and analysis are truly two sides of the same coin, both essential for robust financial health. FP&A, in particular, is indispensable for steering a company strategically and operationally. It effectively combines foresight, through budgeting, forecasting, and modeling, with retrospective analysis using financial ratios. By doing so, FP&A equips decision-makers with the critical insights needed for sustainable growth and effective resource management. Together, FRM and FP&A form a powerful framework for comprehensive financial success. Thank you for joining this consolidated recap session. I hope this overview of financial risk management and financial planning and analysis has been insightful and valuable. We now open the floor for any questions and discussion you may have. Your engagement is highly encouraged as we deepen our understanding of these critical financial disciplines. See you in class.